You are watching a moment that historians may one day describe as the point when the illusion of monetary stability finally cracked in plain sight. Early February 2026. Gold is trading near $5,000 an ounce. Silver, after violent swings, hovers in the mid-70s, recovering from collapses and surges that feel less like normal markets and more like seismic tremors. Just weeks ago, silver was above $100. Then it plunged in a single, brutal wave of liquidation. Now it rises again. This is not noise. This is stress inside the system. You are witnessing markets behaving in ways that no longer follow the old rules. Stocks can rise while currencies weaken. Gold can surge even as interest rates remain elevated. Silver can collapse and rebound in days while physical demand tightens beneath the surface. These are not healthy signals. These are fracture lines. Now we need to talk about what makes this moment different from every commodity cycle that came before. There was a time when metals rose for simple reasons. Inflation ticked higher. Central banks cut rates. Investors sought safety. Prices climbed. But today, the correlations are breaking. Gold has risen more than 70% year over year, even as the dollar periodically strengthens and markets price in tighter policy expectations. Edom Reuters. Silver has surged more than 100% year over year, yet it has also experienced violent collapses of 30% in days. Money Week, strength and instability are now happening simultaneously. This is not a normal bull market. It is a disorderly repricing of reality. And the most dangerous signal is not that metals are rising. The most dangerous signal is that they are rising, while the global financial system is still pretending everything is under control. This brings us to the deeper truth that few are willing to confront. Assets are not rising. Currency is eroding. For more than a decade, governments across the world have expanded debt at a pace never before recorded in peacetime. Central banks created liquidity on a scale that would have been unimaginable in previous generations. Balance sheets exploded. Sovereign deficits widened. Real interest rates turned to negative for years. When money supply grows faster than productivity, purchasing power does not decline slowly. It declines in waves, sometimes hidden, sometimes sudden. Gold is the first alarm bell. Silver is the echo that comes later, but louder. Now we need to talk about the real cause behind the silver market specifically, because this is where the system begins to reveal its contradictions. Silver is not just a monetary metal. It is an industrial metal embedded in the infrastructure of the modern world. Solar panels, electric vehicles, data centers, advanced electronics, military systems. Every one of these sectors is expanding, and yet global silver supply has not kept pace. The world has experienced repeated structural deficits in silver for years. Investing.com. In some estimates, the shortfall in a single year has reached hundreds of millions of ounces. Kotak Mutual Fund. This is not a temporary imbalance. It is a structural one. Mines cannot ramp production overnight. Silver is often a byproduct of other metals. New projects take years to permit and build. Ore grades decline. Environmental restrictions tighten. Capital becomes scarce. Demand, however, is relentless. Solar capacity alone is projected to expand dramatically, with each installation requiring increasing amounts of silver. Goldinvest.de. This is where the pressure builds, because silver sits at the intersection of two unstoppable forces: monetary instability and industrial necessity. And when those forces collide, volatility becomes extreme. This brings us to the most dangerous signal of all, the signal almost no one understands until it is too late. Physical markets are tightening while paper markets remain fragile. Leasing rates have risen. Inventories have been drawn down. Arbitrage flows increasingly move metal from west to east, from vaults to fabrication, from futures exchanges to industrial supply chains. This is how shortages begin, not with empty shelves, but with rising delays, widening spreads, and sudden price spikes that appear without warning. History has shown this pattern before. In the 1970s, precious metals did not rise in a straight line. They surged, collapsed, and surged again. Each correction convinced people the crisis was over. Each rebound proved the opposite. Now we need to talk about global confirmation, the evidence that this is not an isolated phenomenon. Central banks around the world are accumulating gold at a pace not seen in generations, with purchases projected to remain extraordinarily high through 2026. Reuters. This is not speculation, this is strategy. When central banks accumulate gold, they are sending a message without speaking it aloud. They are preparing for a world in which currencies are less trusted, settlement systems are more fragile, and geopolitical fractures reshape trade itself. Silver does not receive the same institutional attention, but it does not need to, because silver is being absorbed by industry, not vaults. One market buys to hedge, the other buys because it must, and that distinction matters. Now we arrive at the contradiction, the lagging signal that reveals the psychology of the crowd. Despite structural deficits, despite industrial demand, despite monetary instability, silver still trades far below levels that reflect its full scarcity relative to gold. The gold-silver ratio remains a psychological battleground, reflecting fear, hesitation, and disbelief. FXS Street. Investors trust gold first. They follow silver later. This delay is not random, it is human nature. People accept small changes gradually. They resist large changes until reality forces them to accept what they can no longer deny. Silver is the metal of late realization. When it moves, it does not move gently. Now we need to confront the final truth, the one few want to hear. The system is not collapsing overnight. It is eroding in slow motion, punctuated by sudden shocks. Debt levels continue to rise. Governments continue to borrow. Central banks continue to navigate between inflation and recession with tools that grow less effective each year. Liquidity cycles become shorter. Volatility becomes sharper. Market reactions become more violent. Time itself becomes an enemy, because in a world of digital settlement, algorithmic trading and leveraged markets, prices no longer move over years, they move over weeks, sometimes days. The window between realization and reaction shrinks. And this is where the final verdict emerges. We are not watching a commodity rally. We are watching a regime change, a transition from a world where paper promises were trusted without question to a world where tangible assets, energy, and materials begin to reclaim their role as anchors of value. This transition does not happen smoothly. It never has. The 1970s taught this. Emerging market crises taught this. Every monetary turning point in history taught this. First comes disbelief, then volatility, then acceleration. You are standing in the volatility phase now, and doing nothing is not neutral. Doing nothing means accepting that the system will determine the outcome for you. Prices will continue to swing. Headlines will continue to change. Analysts will continue to debate. But beneath the noise, one reality remains constant. Supply cannot be printed. And when the world finally understands that simple truth, the repricing does not ask permission. It simply happens.